At the beginning of 2025, I published a list of 5 stocks that I believed were positioned to outperform over the year. Those picks, ASML, LVMH, 3i Group, Google, and Amazon, delivered exactly that. A portfolio equally weighted across the 5 would have outperformed the S&P 500 by 9.4% and the NASDAQ 100 by 5.9%, despite mixed sentiment across multiple sectors. While not every position was flawless, the overall outcome reinforced my belief that combining structural growth with valuation discipline can consistently beat benchmarks. Looking ahead to 2026, market conditions remain volatile, sentiment-driven, and often disconnected from fundamentals. That environment tends to reward long-term investors willing to look beyond short-term narratives. The following stocks are exceptionally well-positioned for 2026. Each operating in a different market segment and all offering meaningful upside even under conservative assumptions. 1. Salesforce has struggled with negative sentiment as investors fear that AI agents from OpenAI or Google could make CRM platforms obsolete. I believe this fear fundamentally misunderstands Salesforce's position. AI agents require clean, unified, permissioned data, and Salesforce owns the data layer enterprises already rely on. By vertically integrating its data cloud with its Agentforce platform, Salesforce has embedded itself deeper into customer workflows rather than being displaced. Adoption metrics for Agentforce have been strong, and management has clearly aligned the company around agentic AI. At today's valuation, Salesforce only needs approximately 5% annual revenue growth to justify its current market cap, with recent growth near 9% and global CRM markets expected to grow between 10 to 15%. Assuming 10% growth implies a fair value of roughly $316 billion, or approximately 33% upside. 2. Amazon has gone essentially nowhere over the past year as investors worry about AWS competition and lingering retail margin pressure. These concerns ignore Amazon's vertically integrated flywheel, where retail scale fuels Prime, Prime fuels advertising, advertising lifts margins, and margins fund lower prices and faster delivery, while restarting the cycle. AWS remains the backbone of this ecosystem, and one of the few cloud platforms with true global scale and profitability. Under conservative assumptions, Amazon trades close to fair value, but if AWS growth stabilizes near market rates and margins across retail and advertising continue converging toward peers, Amazon's fair value rises toward $4.6 trillion, implying up to 96% upside in a bull case. 3. Hims & Hers. Hims has sold off sharply following FDA clarity on semaglutide shortages, raising concerns over compounded GLP-1 offerings. While sentiment collapsed, fundamentals did not. After a brief Q2 slowdown, growth resumed immediately in Q3. More importantly, Hims is evolving into a personalized healthcare platform, not a one-product GLP-1 play. Mental health, dermatology, menopausal care, and international expansion are all growing rapidly. Owning its own 503B facilities gives Hims tighter quality control, faster product iteration, and superior margins. At current prices, Hims only needs approximately 9% annual growth to justify its valuation. Using management's 2030 guidance implies a 22% plus CAGR, suggesting 100% plus upside. 4. Novo Nordisk has been punished by lowered guidance, pricing concerns, and intensified competition with Eli Lilly. Sentiment is now so negative that the market effectively assumes little to no growth. That assumption is unrealistic. Even excluding obesity, Novo's diabetes and insulin franchise alone supports approximately 5% growth. Including reasonable obesity growth yields a blended rate near 11%, implying the stock may be approximately 85% undervalued. The market appears to be extrapolating short-term pressure far beyond what fundamentals justify. 5. Nebius has been hit by dilution fears and a broader cooling in AI infrastructure stocks. But unlike most AI plays, Nebius has already secured demand. Multi-year contracts with Microsoft and Meta, totaling approximately $22 billion, effectively match its entire market capitalization, with management targeting $7 to $9 billion in ARR by late 2026. Nebius only needs approximately 10% growth after 2027 to justify current prices. Assuming still conservative 35% growth beyond that suggests up to 150% upside even without heroic assumptions. Conclusion: these 5 companies span enterprise software, cloud infrastructure, healthcare, AI, and consumer platforms, with diversification across geographies and end markets. In each case, today's valuation reflects overly pessimistic assumptions. Simply achieving market-level growth could unlock substantial upside in 2026. If sentiment normalizes and fundamentals reassert themselves, I believe this basket has a strong chance of outperforming the broader market once again.